Hey there, tech enthusiast. Get ready for Tech Ties and Human Vibes, the podcast where technology in the AI era meets the human touch.
You are listening to another episode of Tech Ties and Human Vibes, and we are here today. Nancy and I are here today with Jason Smith from the Monolith Group. And I don't know exactly what you do, Jason. You're going to have to fill us in a little bit. Just help me understand and help our listeners understand exactly what you do. So go for it.
Of course. Yeah, well, thank you for having me. I would say my core focus is helping entrepreneurs pay less in tax. That's what really drives me and gets me excited. That's what gets me out of bed in the morning. Specifically, the Monolith Group is focused on estate planning strategies that allow business owners and wealthy families to really plan for multiple generations and offers them an opportunity to help kids, grandkids, maybe even generations they'll never meet, take advantage of the blessings that come from successful business ownership. So the Monolith Group, our founder, very smart, very entrepreneurial man, John Gazowski, he developed a process that allows private families to issue institutional debt. And institutional debt comes with much lower rates of interest than you'll find if you go try to borrow money from your bank. And so by borrowing money at such a low cost, these wealthy families are able to purchase large life insurance policies without having to pay the premiums out of pocket. And so that's a very powerful tool when you're able to leverage your existing net worth to create a tax-free liquidity event, just cash into your estate when you pass, that your heirs can then use to pay estate tax if that's due. But also, just because you die doesn't make it a good time to sell your business or to sell that piece of valuable real estate. And so providing a large cash event upon your passing allows your family to really figure out what's the best route for the business, the real estate, the assets, rather than a fire sale. So that's a really big impact from a tax perspective, from a long-term planning perspective. And that's one of the major tools in my tool belt for helping people pay less in tax.
Huh.
So
Well,
you said something that got me going in the sense of well, one, you're talking about generational tax savings, which is like crazy. I don't think I've ever heard it be talked about in that way before. But two, something very important that you said, which was trying to not go down the route of a fire sale, which is a lot of the times what ends up happening when an entrepreneur or business owner passes away and the family is left to just deal with the ramifications, right? And something that usually happens within that part is, especially if the family's not involved in the business, they don't actually know the value or what could be the potential value if it were to stay within their hands and keep growing and things like that, right? So tell me a little bit more about that aspect of it.
Absolutely, yeah. So if you think about when the founder, owner, major operator passes away, and is still that main person in the business, that's a significant risk. There's something called a key man policy in the life insurance space that's used really to help the survivors have some time and buy some time to figure out what to do. And I would say that our program comes alongside hopefully some other planning that they're doing, some succession planning, or being prepared to sell. Just because you don't intend to sell doesn't mean you shouldn't be prepared to sell. Meaning, are your financials in good order? Is your business operating on processes? How can you begin to not be the bottleneck of the business? If I joke with people, then the number one symptom I see of too much owner engagement is they're the lead salesperson in the company. If you're responsible for most of the sales of your company, you don't have a business. You are self-employed with a supporting cast.
I love
Um,
that.
and so our program
That's a
comes alongside
great
that.
segment right there, just so you know. That's great.
So whether it's a partnership needing a buy-sell agreement, needing to fund a buy-sell agreement, or in an instance where someone passes away, let's say unexpectedly, wouldn't it be nice to have a liquidity event that allows you to go out and maybe search for a new executive to keep the business running, or perhaps invest in some training for some key managers, or yourself as the second generation to step into that business. And so I have yet to encounter a situation where someone said, that extra cash didn't really help us execute our vision. That money just helps things. It buys time, really, is what it does. And so I would say that's really where that program for entrepreneurs makes particular sense. Is it gives them the bandwidth and the time to consider options, still make payroll, still keep the business afloat, and maybe you're just in a bad business cycle, for a particular set of industries. As macroeconomic events happen, certain businesses fall in favor, fall out of favor. Perhaps you just need that 18-month window to wait for your business sector to come back into favor in order to sell a business. So that's where we see our program helping, particularly those family-owned businesses who still have rather a small concentration of responsibility.
So where do you okay, so let's just say I'm an entrepreneur, I'm a small business owner. At what point would I look to you for help and set that up? I mean, I'm just a one man shop, or when I hit like a 5-man shop, at what point do I seek you out?
Yeah, so for something of that nature, I would say you really want to have some good momentum behind your business. You want to be beyond the startup phase. What I tell people is you want to look at the risk reward situation that you're in. So if you're starting up, you have a couple of employees, you still have to be daily hands on. You're still growing that business, and the risks that we've just spoken about are far less than the risks of maybe making payroll, of that next client really allowing you to show a profit for the first time. So I would say the business needs to be maturing. And then especially if there are multiple partners, multiple owners, I would say when you begin to generate repeatable, consistent profit is when you need to be looking at ways to protect that profit.
Hmm.
Okay. Yeah, that makes perfect sense. And so, really, when it comes down to it, knowing about it when you are a certain phase is great, but taking action once you are at a more mature level is really where you have to be in order to take advantage of this and to start thinking about the big picture, right? The end
Yes,
in mind, ultimately.
because what we're talking about is mitigating risk. And
Right.
ultimately, that's what doesn't show up on the balance sheet, but has a significant impact on the balance sheet is risk. And so, if you think about things like insuring your vehicles, let's say you're a structured cabling company, right? You've got a lot of assets that it takes to go and deliver your service. You're going to insure those vehicles for a variety of reasons, but mainly because those are critical to the delivery of your service. So you want to push that risk off your balance sheet, and you pay a fee to do that, right? You pay an insurance premium. So the types of risks I'm speaking of are more large strategic risks to the success of the business based upon those individuals being available to run the business and less about the components of the business. But there's still risks, and you decide at what point does a particular risk um, have too big of an impact on the balance sheet if that risk were to come true, and how do you want to then delegate that risk to someone else, push that risk off your balance sheet. So the death of a partner at a startup phase, while sad, wouldn't have a significant financial impact on the business.
Mm.
However, let's say you've got a $10 million business and two partners. If one of those partners passes away, the estate of that deceased is owed something, right, for their ownership, for the value of that ownership. And if we're talking about a $10 million business, it's not likely that there's enough cash flow to support writing a check out of the business to compensate that deceased person's estate. So that's a large contrast that I'm putting forth on purpose, right? Startup, no profit, bootstrap, up to good cash flow, good revenue, enterprise value that needs to be considered.
So along those same lines, and you're helping small business owners save money on their taxes. Is does that go with the same format? Like you're not, I don't want to say you're not interested, but you see bigger savings if your clients are a $10 million shop versus would you even be interested in somebody that's an entrepreneur that's just a single man shop?
Yeah, so it would depend on the revenue. And that's simply because that's how our tax system
Right.
is organized. We're a progressive tax system. And so as you earn more money, a larger percentage of that dollar is taxed. And so, for example, let's start on the higher end and work our way down. On the higher end, let's say someone has $1 million in taxable profit. I'm aware of a structure that allows people to participate in a charitably minded LLC, meaning that the contributions they make into the LLC are ultimately going to likely produce a charitable deduction. And so, for every dollar that someone puts into this program, historically they've received about a $5 tax deduction. So, in our $1 million example, if I put in $100,000, I can expect about a $500,000 tax deduction,
Hmm.
which, after applying the tax rates, et cetera, it nets you about $100,000 positive cash back in your pocket because it's a deduction, not a credit, right? So
Right.
that $500,000 tax deduction at basically a 40% tax bracket is a $200,000 savings. We put $100,000 in as our contribution, so that individual nets $100,000 back in their pocket. So what we're doing there is essentially we're playing an arbitrage game. We're looking for folks that are in the 32, 35, and 37% marginal tax brackets, meaning their income is exceeded those certain levels, and we're helping them find ways to mitigate those higher into the tax brackets.
Okay.
Right. Yeah, that
So
makes sense. Go ahead,
that
Adam.
makes total sense. No, I was just curious. So like if I was a, I don't know, $200,000, let's say $250,000 shop,
Yeah,
and would it be beneficial for me to seek you out?
potentially.
Okay.
And so as we walk back, so I wanted to start on the higher end and walk back. As we begin to move into the lower profit businesses, they certainly need to be looking at certain tax credits they may be eligible for.
Hmm.
One of them is called the research and development tax credit. If as a business you have expenses related to developing a new product or a new process, you could be eligible for the R&D tax credits, and that has no income minimum or maximum. Um, there are organizations that are going to charge a fee to produce the reports that you need in order to obtain that tax credit. So it becomes a cost benefit analysis at that point, and how much of the expenses of your business could be considered R&D related. If it's a
Okay.
high percent, you have a high tax credit. If it's a low percent, that may not be something worth doing. But that is something that, regardless of your profit margin, that you could consider doing. And then I would say on the lowest end of the spectrum is something that everyone should Google, and it's called the Augusta Rule. It's the ability of an individual to lease their personal home out for up to 14 days per year and pay no tax on that income.
Hmm.
So this was actually based on the Augusta Golf Tournament and the Masters in Augusta, Georgia. Those folks lobbied to be able to rent their homes out to people attending the golf tournament, but not have to pay tax on it. And so that's definitely
Interesting.
something worth looking into, because when you own a business, uh, your business can be charged a fee to hold a meeting at your home, and that becomes a tax deductible um, daily rental of a property. But the rent that's paid from your business to you as the owner of the home, you don't pay income tax on that income as long as it's less than 14 days.
Huh.
So if you can plan maybe to have your monthly management meeting at your home, if you're willing to open your home to do that, a monthly management meeting, charge charge a fee to use your home for the day to hold those offsite meetings. There's limitations. It has to be a reasonable amount. It has to be based upon what you might pay, um, in the marketplace for that sort of a rental. So those rates are available. I'm not trying to give tax advice in any specific situation
Yeah.
here today. But I'm just saying that's worth something looking up, or maybe asking your accountant, your CPA, hey, do I qualify for this? How might I take advantage of this?
See,
Very
that's a
interesting.
really good tip there for folks,
Yes.
that is especially if you, work remotely or anything along those lines, that's something that can help in that sense, correct?
Well, if you work remotely, you probably wanted to be looking at taking a home office tax deduction. If if you regularly use your home in the course of business as the business owner, this would be folks who do have an office, who regularly have a place of work, and then they're renting out their home on an ad hoc basis.
Got it,
Mm.
got it. Or so those owners that may have a vacation home and that wanna take their team offsite and, utilize the vacation home as well for those quarterly
And that's
meetings.
And that's where I would defer back to the CPAs, because there are limitations and rules and qualifications, different factors. And so I wouldn't want to speak on any specific example, but I would say if you're a business owner who has a regular place of business and you own your home, it's at least worth asking your tax counsel, your CPA about that.
I thought for
Yes,
sure you were gonna say, "I can help you out with that, but you have to take me on the vacation too." Instead
Right? They gotta take us all if they heard it and are gonna utilize it from the show, right?
we
They
all
gotta
have to
invite
go.
us all. Yeah, we
Exactly.
all have to go.
We'll do the next episode from that location.
That's right, there you go.
So, Jason,
Tax and vacation strategies here.
Mhm.
how do you get started in something like this? I mean, were you in high school one day and been like, I think this is the career for me. Like, what is going on
I
there?
love taxes.
Yeah,
Yeah,
I
I
actually
can
started
just
out.
imagine you.
Career 1.0 for me was in tech. I had a company that we did all low voltage implementations, installations, so point of sale systems, basic network backbone type work. And then we also had a software development arm, helping a lot of people get started with their first e-commerce implementations back in the late 90s, early 2000s. And when I exited those businesses, I didn't really feel like the financial rewards lined up with the amount of blood, sweat, and tears I had put into those businesses, which I'm sure no one can relate to that sentiment here today. But ultimately, what I found was that my financial acumen was really the weakest of my understandings of business. And that sent me on a path through the financial services world to see how could I have done things differently, but also how can I help people to do things differently. And over the course of Career 2.0, which has been in the financial services space for about 15 years now, I ultimately found that taxes are the most consistent expense you're going to face. And the more successful you are, the bigger that expense gets. And so that's what's led me to ultimately want to focus on the tax piece, is to really help the folks that are driving our economy, the small business owners, uh, help them keep more of what they've made, because most of them want to reinvest that back in the business, to hire that additional employee, to open that next location, to expand into the next market. And reducing taxes puts cash back into the business, back into the owner's pocket to do those things.
I love that. I love that. What would you say hold your question, Adam. I wanna dive a little bit into how that impacts or helps the next generation, since at the very beginning, we were talking about, this being generational.
Mhm.
So for the business owners out there that may have, they're baby boomers and are trying to retire and telling the millennials like, "Come on, get going here." What how would something like this help them in that way, or what should they be looking at when it comes to handing that down, I guess, ultimately speaking?
That's a great question. I would hope that as we're uncovering these tax savings, possibly a few things could happen. Either that could help shore up that owner's retirement so that they can begin to offer some ownership to the next generation, to bind them to the business to really make them a part of the business, not just a contributor to the business. So perhaps that's one way to help. Um, Maybe being able to invest in some personal development of that next generation. Use those funds to send them to courses, seminars, classes, not just on how to be better technically, but how to be better business managers, how to become business owners. That's a huge leap that not many people really appreciate until you've done it, is to go from doing the work to managing the business that executes the work. It is a totally different skill set. Um, you know, I think some of the best engineers, the brightest minds in executing on the work, make the worst managers. And so, if
We
we
hear
don't
that all the time.
if we don't offer them a path, if we don't explain and teach, then we're setting them up for failure. So those are two ways I would hope that tax savings could be used in a multi-generational succession planning sort of perspective, is to open up paths so the next generation is interested and motivated, and not simply seeing it as a way to sort of further extract value from them.
Love that. Love
In
that.
your endeavors to helping businesses, what's some of the craziest things you've seen?
Gosh,
Well, you were
craziest.
like, "Holy smokes, what the
Oh,
heck are
that's a
they
good
thinking
question,
there?" Or
Adam. That's a
whatever.
very good question.
Well, I'll tell you, one of the saddest things that I've seen is when people get the wrong advice on how to structure their entity. And so, without trying to give advice in this sort of format, I will say the saddest thing that I've seen is a family that had organized their business as a C corp, which there's reasons to do that, there's reasons not. So they organized this business as a C corp. They've been operating for 7 years. No one ever explained to them how a C corp works. So they were taking all of their income out as W-2 income and none as distributions of profit. Well, income is at much higher rates, much higher progressive rates than distribution income. And so they were literally paying tens of thousands of dollars per year in excess of taxes than what they really needed to.
Oh, wow.
And so somewhere along the way, this family was told, you really should be a C Corp. Here's why. But they weren't guided on how to operate it. No one came alongside them each year and said, no, here's how you use this structure for your benefit. So I see things like that quite often. That's why I'm very careful in these settings not to say too much about a particular structure or idea, because it has to be very much considered at a personal level. Like how is the execution of this idea actually going to happen? And people wind up in C corps because of reels and TikTok videos that say C corps don't pay tax on this, or S corps allow for this or for that. So they go and do those things because it's easy to. You can do these things yourself, but just because you can doesn't mean you should. And you need the right advice you need the right partnerships that are going to give you advice throughout the process of building a business.
Yeah, I don't
Yeah,
think I've ever heard of a process to be able to go back to the IRS and say, "Hey, I think I overpaid you. Can I get some of that money back?" That would be great if you
Um,
can audit the IRS too, you know?
yeah,
Like
sometimes you can actually,
Cool.
but
wow.
at other times you can't. And so certain tax credits you might have missed, you can actually go back and get those. If you own a building, a commercial building, there's some potential tax savings opportunities that can go back to the date that you bought the building. So in some cases you can, but I would say it's always better to take advantage of the tax breaks immediately in the year that they're available,
Yeah.
as much as you can.
Well, I love that because, like how you said, every business is different. So you would set up every business differently, right? It's not a uh, one fits all. And so we kind of preach that too, Nancy. It's not
Mhm.
one, it's not one marketing form that fits everybody, right? Every
Right.
company is different, every business is different, every person is different. And so, yeah, I really like that.
The family dynamics too. I mean, these we can rarely fully separate the operation of a small business from the impact of the family. And so, understanding the family dynamic, I feel, is critical to giving advice on the business. Um, is this a business where you want to raise funds from friends and family and maybe even third parties? There's just so many different things that need to be considered in that process that that blanket advice I don't really feel even exists.
That's a very good point, which means that, especially there's no way that as a business owner you can keep up to date with everything that's happening within the tax world and run your business at the same time, like literally impossible. So being able to have that advice to go to the experts for that have been there, done that, like literally this is what you do day in and day out, is to know these things. That's where it becomes really helpful. And so is there like some sort of algorithm or something that you guys use in order to like understand somebody's situation and provide the best advice on that?
It really comes down to interviews and comes down to a lot of questions, of the family, of the potential client, to really understand what they're trying to accomplish. And that has such an impact on the decisions that we make. We seek to maintain a great deal of flexibility in the planning processes, and that's because things change, life changes. I mean, we've had situations that turn out way better than anyone expected, and we need a plan that's flexible enough to accompany that, to accommodate that. And we've had situations where things took a turn for the south in ways, including family members embezzling money and going to jail for it. And so, how do you change an estate plan, to acknowledge that someone really shouldn't be involved in the business anymore? So, flexibility is paramount in this sort of planning, in order to provide the family the options that they're going to need as the plan unfolds, as the future unfolds.
Like how you said flexibility, and all I thought was pivot, pivot,
Yeah,
pivot. You gotta be able to pivot. But that is
especially
yet again one of the reasons why having experts on your side to help you in those moments where you do have to pivot, it becomes crucial in that sense.
and I'll say, especially in business partnerships. My first business was a partnership. My second was just myself as the sole owner. But especially in partnerships, it becomes important to at least create a baseline plan with some flexibility. Because at the end of the day, all partnerships end. You know, even if it's the death of the partners, the bottom line is partnerships do end, and you've got to have at least some acknowledgement of that and some base level plan to determine, if we decide to part ways on good terms, if something happens and we part ways on less than good terms, if we sell the business, if one of us passes. So I'm not sure how much of your audience finds themselves in partnership sort of arrangements, but I would say that those are a higher priority to begin to address some of these questions than a single owner, a sole proprietor, just because the number of partners, you're literally multiplying the impact of decisions by the number of partners that you have.
That's a good way to look at it.
Yeah, it is. It is a very good way. Um, uh, Jason, really quick, if I was somebody that wanted to get a hold of you, what's the best
Mhm.
way to do that?
Yeah, so my cell number, texting me, is actually a great way. I don't answer many calls that I don't know the phone number of. And so, my cell number, 817-726-6859. If someone texted me and said, "Hey, I saw your interview. I want to learn more. What should I ask my accountant? Can you talk to my accountant?" No, um, that's a great way for me just to point you in the right direction.
Okay.
Awesome, awesome.
Yeah.
And are you working with people across the country? Are you focused on regional areas? How does that work, especially when it comes to, I know, like state taxes and a bunch of other taxes that can get complicated?
It can get complicated, and so I work with anybody who pays tax in the U.S. That includes folks that are here on various types of visas or things of that nature, or they've made investments in the U.S. But maintain citizenship elsewhere. So, if you pay tax in the U.S., I'm here to help. Um, I would say on the state tax issue, that's where I really require the partnership of a CPA that works in that state. And so my focus tends to be at the federal level because those are where we can have the biggest impact. And in some cases, those tax deductions can flow through to your state tax filing. So, for example, the charitable sort of strategy I mentioned early on, there are some states that recognize charitable deductions, charitable contributions, and there's some states that are income based without deductions.
Hmm.
So, what we do at the federal level can only potentially help at the state level, but it doesn't always help at the state level.
Okay, that's good to know. See, it gets complicated.
It
It
does. So
does.
just to be fair, nothing outside of the U.S.
That's correct, right? So now, if it's a business in the U.S. doing business internationally, there's tax credits. It's called a foreign tax credit. If you pay tax in another country because you sell your products in that country, there's a potential that you could reduce your domestic taxes by the amount of tax that you paid in that foreign country. There's a formula involved with that again,
Oh, okay.
another complicated formula. Um, but I would say anyone domiciled in the U.S. or paying taxes to the U.S. government would be folks I could potentially help.
Okay. Yeah.
Love that. Love that. And since we are in the business of tech, I want to know, how are you utilizing AI to help you with your business and or with all of these complicated concepts with tax?
Well, it broke down to one big, beautiful bill for me. I asked it to summarize the key components of the bill. I like to give it scenarios. So I subscribe to OpenAI, and I also use Grok and Claude. I find that the different approaches those LLMs are taking, provides different perspectives. And so I went through and I said, hey, I own a business that manufactures widgets, and we do X amount of revenue, and we have this many employees. So build out a bit of a profile and say, how does the One Big Beautiful Act impact me? And then I would do it for a service business, and then I would do it for a much larger business. So that's where I found out that they've increased the income limit for a particular type of rule. So now I think it went from 25 million to 75 million of revenue for you to still be able to take advantage of some certain rules.
Hmm.
So it uncovered that for me. And then secondly, I use it quite a bit to look at existing tax credits and tax deductions. And so I use it as a check, to make sure that as things change, I'm staying up to date, and also that I'm continuing to bring forward the best ideas available, because our tax code is just massive. Unfortunately, with the LLMs being given access to the full internet and these large document repositories, they are now being able to help me understand the tax code that is just impossible to read cover to cover.
That's
Oh, I
actually
love that.
really that's really interesting. You used it to help you with taxes. I love that. I would have never thought of that. There's so many different ways that AI is just amazing, and
Hmm.
yeah, never thought about that.
Yeah, okay, so disclaimer before anybody goes out and starts to try and do their taxes with AI. Still seek the experts.
It is a
Um,
good research tool. That I
Yeah,
think that's the key is allow it to point you in a direction, allow it to help inform better questions. To your tax advisors, to your CPAs, to your attorneys who are helping you set up these entities. It helps you understand your own business better when you ask better questions.
yeah,
Solid advice. Solid advice.
very cool.
Love that.
Well,
Oh,
Nancy, I was going to ask if you do you have any other questions?
Um, no, I think that yeah, I think that it's great, especially for anyone that is a tech professional, since you come from that world. That
Mhm.
was 1.0 for you. That's where you started. And so you understand that world a little bit better. So definitely any last words of advice that you would have for, anyone within the tech industry that is looking to see what can they do in order to, not have to pay so much taxes or anything along those lines? Prepare.
Yeah, I would say,
Yeah.
yeah, I would encourage people that it's worth the time. I know as business owners, time is the resource we can't make any more of. We can't get back. And so it's the most valuable resource in my opinion as an entrepreneur. But I'll tell you two things. First, it's worth the time to investigate these things because it's a compounding benefit to you. So when you learn of a new tax savings opportunity, it's not just this year, it's every year going forward that tax situation, as long as it remains in the law, you're able to take advantage of. So you find it and you learn it once. Maybe that took you 10 hours, but you're going to apply it for the next 10 years. So I think it's important to carve out the time and make a commitment to do that. The second thing is don't be afraid to interview and to question your CPA. Now, giving them grace, CPAs are busy. They work on deadlines. They are overwhelmed and many times understaffed. That industry as a whole is going through a very tight talent issue. People just didn't want to get into that space for a long time. And so, giving them their graces, it's not an easy business to be in. So you have to take personal responsibility if you want to pay less in tax, bring ideas to them. And that's the opportunity to see, is this someone who wants to come alongside me and help? If you're just dismissed out of hand without explanation or conversation, maybe consider changing CPAs, someone who's willing to be more cooperative with you as a business owner, explore ideas, tell you why you're wrong. Okay, if I'm wrong, please tell me. Just don't let them be dismissive of you.
When's the best time to find a CPA? You definitely don't want to wait until, I mean, if you're filing once a year, right? I understand. You probably want to do it sometime in the mid-year, right? You don't want to wait until December 1st or January 1st to try to find a new CPA. So is there a time?
Well, I'm finding the CPA firms that are also offering the bookkeeping and managing your financials, they are the ones that are more consultative. So if they're doing your monthly or quarterly reconciliations of your books, those are opportunities to have at least a brief discussion about where your business is and at what levels of profit do certain tax strategies start to make sense, or what types of activities could start to make sense. So if you have an engagement where the CPA is running your books, let's say they're doing your quarterly reconciliations, and for the first time, let's say you have a new category of expense related to research and development. Well, that CPA now has at least the opportunity to say, hey, these expenses look like you might be doing X. There's a tax credit associated with X. Can we have a conversation about that? Now, I understand from a cost perspective, many business owners are going to say, well, I do my own books. I don't need anybody doing my books. Well, maybe you don't need someone doing your books for data entry purposes, but that becomes the bridge between you and the tax savings with someone that's at a CPA firm who wants to get in the weeds with you, who wants to bring you ideas rather than simply, taking your information, putting into their software and spitting out tax forms.
So what I hear is proactive, not reactive.
Mhm. Absolutely. And understanding that the bookkeeping and the financial services are the on-ramp to a better relationship with your CPA. It's really not an upsell. I promise you, they're not making a ton of money doing your books. Like, um, it's really an on-ramp. It's an opportunity for those CPAs to come alongside you in a more cooperative role than to simply, show up with a shoebox on, February 15th.
Thanks for joining us today on Tech Ties and Human Vibes. If you'd like to keep the conversation going, exclusive tips from our speakers, and more, head over to the community at sibylcommunity.com.